Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
So Janine, let's start with this compelling report from Concordia University's John Molson School of Business in Equiton. They're saying that if the housing supply trends continue as they are, Canada could see some substantial home price increases by 2032.
Yes, Steve, and the report highlights that Toronto and Vancouver would lead this price appreciation. The research led by Erkan Yunder used artificial intelligence to analyze housing supply across major cities, focusing on Toronto, Montreal, Vancouver, and Calgary. It's quite a comprehensive study, considering various factors like regulatory policies and construction costs.
The numbers are pretty staggering. The study suggests that without intervention, median home prices could reach $1.8 million in Toronto and $2.8 million in Vancouver by 2032. That's a huge increase from today's prices.
Absolutely, Steve. But what's interesting is that the study also shows potential solutions. For instance, doubling the current housing completions in Toronto and Vancouver could bring those median prices down to $1.6 million and $2.5 million, respectively. It seems like boosting supply could really make a difference.
And Janine, they also looked at how regulatory changes could impact housing completions. A 10% decrease in building restrictions could increase completions by nearly 10%, and cutting approval delays could add another 3% to completions.
Right, but it's not all about the regulations. The study warns that a 10% rise in input costs could reduce housing completions by 25% to 35%. That includes costs like materials, taxes, fees, and labor, which would impact apartment-style projects the most.
It's a complex situation for sure. The AI-driven analysis provides a dynamic view of how policy and global market conditions are shaping Canada's housing markets. It's fascinating to see how data-driven models are now being used to quantify these complicated interplays.
And the city-specific results are quite telling too. In Montreal, for example, price growth continues regardless of supply due to low completions relative to demand. Meanwhile, Calgary's housing prices seem more responsive to population changes than supply levels.
Christopher Wine from Equiton Developments mentioned that this AI platform is a game changer for forecasting. It's useful for identifying opportunities and managing risks in the real estate market.
Yes, and the study concludes that while regulatory reform and cost stabilization are necessary, they aren't sufficient. Challenges like skilled labor shortages and construction timelines still pose significant hurdles. Yunder even suggested that diversifying growth beyond Canada's largest cities might be necessary to meet long-term housing needs.
Janine, the latest jobs report from Statistics Canada has certainly stirred things up in the financial markets. The economy lost 40,800 jobs in July, which is quite a stark contrast from the 83,000 jobs added in June. This unexpected downturn has shifted both market and economist expectations regarding the Bank of Canada's future interest rate moves.
Yes, Steve, and it's really concerning to see such a significant loss in jobs, especially when analysts were expecting an addition of 13,500 jobs. The unemployment rate remains at a multi-year high of 6.9%, which is troubling. It seems like the private sector took the hardest hit, with full-time employment dropping across various industries.
Indeed, Janine. The Canadian dollar took a bit of a hit initially, but managed to recover most of its losses. However, bond yields softened, and market odds for a rate cut by the Bank of Canada have increased. Currently, there's about a 38% chance of a quarter-point rate cut at the next policy meeting in September, and more than a 50% chance by the end of October.
It seems that the decline in employment was mostly concentrated in British Columbia and Alberta, with factors like wildfires potentially affecting those areas. But on a national level, there were some positive notes with sectors like educational services and transportation showing job increases. Still, the overall picture is worrisome.
Alexandra Brown from Capital Economics highlighted that this jobs report makes a strong case for the Bank of Canada to consider rate cuts soon. But she also warned that a strong consumer price index report next week could pause any immediate action. It's clear that while the jobs data is weak, inflation figures will play a crucial role in the decision-making process.
And Veronica Clark from Citi mentioned that despite the job losses, the unemployment rate held steady only because labor force participation dropped. It's not a positive sign when the participation rate is declining. This could indicate broader economic issues that need addressing.
Exactly, Janine. Economists like Andrew Grantham from CIBC Capital Markets and Douglas Porter from BMO Capital Markets are pointing out that while the jobs report is weak, there's still more data to come before the Bank of Canada's next rate decision. They're keenly watching the upcoming employment and inflation data releases.
It's a moment of uncertainty for sure, Steve. Leslie Preston from TD Economics pointed out that although the unemployment rate is steady, it's due to a decline in labor force growth. This stagnation isn't ideal and could keep the unemployment rate from rising too high despite weak labor demand.
Taylor Schleich, Ethan Curry, and Noah Black from National Bank Financial noted that a softer labor market should put downward pressure on inflation, which might support rate cuts. However, they emphasized that the next two consumer price index reports will have a significant impact on the Bank of Canada's decisions.
That's right, Steve. Claire Fan from the Royal Bank of Canada believes that while the labor market is softer, the worst of tariff-related damage might be behind us. She doesn't foresee further rate cuts from the Bank of Canada, but it's clear that the economic conditions are still evolving.
Middlesex Centre is making strides with the federal government's Housing Accelerator Fund, which is managed by the Canada Mortgage and Housing Corporation. This initiative aims to enhance land use planning and streamline development approval processes to boost housing supply more rapidly. Middlesex Centre will receive a total of $4.24 million over 4 years, with the first installment of over $1 million already in hand for 2025.
That's right, Steve. This funding is a significant boost for the municipality, allowing them to implement their housing action plan. The goal is to create 645 new housing units by the end of the program, and Middlesex Centre is committed to achieving this in a timely and effective manner. It's wonderful to see this level of support aimed at addressing housing needs.
Indeed, Janine. An interesting aspect of the plan is the focus on ending exclusionary zoning. Middlesex Centre is reviewing its official plan and zoning bylaw to remove low-density zoning restrictions, allowing for a broader range of housing options. This includes affordable and social housing, as well as mixed-use and higher-density developments. It's all about optimizing land use and reducing the need for rezoning.
It's exciting to see Middlesex Centre taking such proactive steps. By allowing up to 4 residential units as of right in fully serviced settlement areas, they're really opening up possibilities for more diverse and inclusive communities. The focus on increasing process efficiency through e-permitting and digital tools is also commendable. It's all about making the approval process more transparent and user-friendly.
The municipality is also prioritizing rental and affordable housing by establishing a dedicated review pathway to expedite approvals for these types of developments. By doing so, they can reduce time and costs, simplifying the process of bringing these crucial housing types to market. It's a strategic approach that could yield significant benefits.
Yes, and Middlesex Centre is also working on community improvement plans to provide wider incentives for housing development. This includes incentives for missing middle housing, townhouses, and innovative construction methods. It's a comprehensive strategy that not only addresses current needs, but also anticipates future demands.
The municipality is designing guidelines for additional residential units, which will support their creation by providing a toolkit outlining planning and building requirements. This kind of forward-thinking approach could simplify the permitting process and encourage more developments.
Absolutely, Steve. By assessing the feasibility of providing pre-reviewed ARU designs, Middlesex Centre is demonstrating a commitment to innovation and efficiency. It's encouraging to see them setting such a strong example for other municipalities.
Now, Janine, let's delve into Daniel Fuchs's recent analysis on the Toronto real estate market. Despite the headlines proclaiming a rise in sales, Fuchs argues that this doesn't necessarily mean the market is back to its previous booming state.
That's right, Steve. Foch points out that while sales are indeed up by 10.9% year over year, this increase comes from a very low point last year. So, while it looks impressive, it's more of a rebound from a slow period rather than a full recovery.
Exactly, Janine. It's important to look beyond the surface. The average home price in the Greater Toronto Area is down 5.5% from last July. Detached homes are down 5.1%, and condos have dropped by 9.3%. These aren't just minor adjustments, they're significant corrections.
And with these price drops, affordability seems to be improving, at least superficially. More buyers are entering the market because prices have come down to a level that's more accessible, but it's a complex picture as mortgage rates remain high and qualification is still tight.
That's the crux of the issue, Janine. Even though more homes are available, with active listings up 26.2%, it's not due to new supply. It's the existing inventory that's taking longer to sell, indicating a demand-side problem. Buyers are hesitant and homes are lingering on the market.
The condo market in particular is feeling the pinch with significant price drops, especially in the 905 area. Incentives and price reductions are common as sellers try to entice buyers. It's a challenging environment for those holding pre-construction condos.
Daniel Folk also highlights that the market lacks momentum. There's no urgency to buy because waiting could yield better deals. This lack of urgency is reshaping buyer behavior, leading to more negotiation and reduced seller expectations.
Yes, and this psychology shift means that while sales volumes may rise, it's often due to opportunistic buying rather than a genuine market recovery. Buyers are looking for bargains, and sellers are adjusting their expectations accordingly.
Fauch notes that the real momentum will come when interest rates ease and sellers adjust their expectations to what buyers can afford. Until then, we'll likely see this kind of gradual sideways movement in the market.
It's a waiting game, Steve. The market is trying to stabilize, but it's not bursting back to life just yet. As Foch points out, understanding these nuances is crucial for anyone involved in the market right now.
Absolutely, Janine. And with that, we'll wrap up today's episode. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.